Okay, good morning. So, we can now start to approach, if you like, the first of the two main financial statements in accounting. This first one is known as the income statement or the profit and loss account. So, let me just go out here and go to do some writing. So, it is known as oh, here we are. So, the income statement or the trading profit and loss account. And I'm going to break this down, this idea of it being called the trading profit and loss account later on. But it's also known as the income statement. And when we talk about the income statement, all we are actually looking for is we are looking to calculate profit. Now, just a bit of background. You remember from our accounting equation, which is why I sort of spend that time looking at this, that when we're looking for profit, we are interested in I's and E's. And profit really is the difference between I and E. That's the first thing. So let's sort of take that and go into our slides, and we'll just break it down as we go along. So the aim and objective of this is to look at the income statement, to look at the structure of the income statement. So yes, we understand the theory behind it, which is the accounting equation. But of course, for users of this information, we need a structure that's sort of nice and tidy and clear that everyone can use. And so, yes, it does measure the day-to-day sales revenue and expenses, and it allows us to provide a calculation of how much profit or loss a business has made over the reporting period. And yes, typically it covers a 12-month period. So that's sort of the culture to prepare an income statement for 12 months. But with computers now, you can easily generate profit and loss for whatever, a month, 3 months, whatever. But that's the usual mode of presentation. Now, the income statement is divided into two parts. So this is just the layout. There's a trading part and there's a profit and loss part. And that's why it's called the trading profit and loss account. The trading part looks at the relationship between the selling of the product and the cost of the actual product. So we're really, let's go back here and let's get a new slide. So what am I saying? Let's go back to our accounting equation. So we have D plus E plus A is equal to C plus L plus I. And we've said that profit is I minus E. So we literally move the E over here. And that's fine. But the question is, we have different types of E's. I mean, we only have one type of A most of the time, which is just whatever you sold the product for, sales or revenue. You can call it sales or revenue. But with E, we have the actual purchase of the product. So for example, if you sell cakes, you actually have to arrive at a cake, you need to buy flour, butter, sugar, yes, milk. You have all of these costs. And then you have some other types of, purchases is an E, but we have other types of E's like light and rent and water. So we're not going to be able to make this cake without light and rent and heat and water. But then we also have a different type of cost, which is butter and sugar and whatever. So we have different classifications, if you like, of E's. So what we tend to do is, first of all, subtract these E's and then get a profit, a type of profit, and then subtract these E's from that profit to get the rest of the profit. And that's all it really is, a different type of classification. And we'll discuss later why we separate this type of purchase and this type of purchase. I'm sure you're probably working out that these ones here, for example, in terms of making a cake, as in butter and milk and sugar, these are direct costs. It's direct. They're referred to as direct costs. There's no way, you will never arrive at a cake without butter and milk and sugar. But it's very possible to arrive at a cake without having to pay rent in the center of London. You can make a cake at home. So really, these are indirect costs. But again, just confirming that it doesn't matter whether you're in the city of London or in Chichester, you will not arrive at a cake without butter or milk. But you can arrive at a cake without having to pay high rents or rents in certain places. Right. So I guess one argues that it's all quite, debatable, but most of the time we do our best to separate these two, but it's just really for decision-making purposes. Okay, right. So let's go back to our slide. So this idea of the trading account, the aim is to separate clearly the costs of making the product from the indirect costs. And we'll look at examples, in a second. And I say the difference between the two, between sales and these direct costs, is referred to as the gross profit. Once we have found the gross profit, we deduct all the other overheads that I was talking about, like electricity, rent, stationery, wages, and then we arrive at net profit. Okay, so this thing here, this cost of sales, we talked about it earlier on, and if you remember, I explained, let's just go back here, just to show you the theory again, to bring theory, always trying to bring theory into this, so that you can sort of see what we're saying. Remember, here we are, we had D plus E plus A is equal to C plus L plus I. So for example, remember we said we bought some goods worth 40,000, first of all, it doesn't matter, we bought them on credit, and then we sold 20,000 worth of those goods for 30,000. If you remember. Now the question is, we said we couldn't just simply say the profit was, gross profit for now. We can't just simply say gross profit is I minus E, because E is somewhat overstated. We didn't sell all these goods. If you remember, we had to deduct, and I'm just going to change the color. We had to deduct what it was we didn't sell, which was the 20,000 from here, and put it under A, which now leaves E at 20,000. So really, this E, what you're seeing here, is referred to, we talked about this before, cost of sales. So really, profit or gross profit, if you like, if you want to argue this, is equal to I minus cost of sales. And what is cost of sales? Cost of sales really is purchases, which in this case is the 40,000, minus the closing inventory, which was 20,000. And that's how, here this is 30,000, right? So 30,000 minus the 20,000, which gives us a gross profit of 10,000. And then we would have other expenses, like light and rent. Maybe rent was 5,000. We have 5,000 here. Maybe you might have paid that out of the bank straight away. So all these are other expenses that will ultimately come off, if you like, this profit figure as you carry on. Right. So let's quickly finish this slide so we can look at an example and see what is going on. So here we are. Here is the trading account. This is what cost of sales is. We've already worked out cost of sales earlier on that just a second ago. But this is, if you like, we have opening inventory plus purchases minus closing stock. This is the cost of goods sold, and this, whatever we get here, we take away from revenue to find profit. Now I'll say that again. This is cost of sales, opening stock plus purchases less closing stock. This gives us our cost of goods sold. Take this away from revenue and you will have your gross profit. Okay, right. Oh, sorry, I think I've gone backwards. Yes, of course, and as we said earlier on, once we've worked out our gross profit, we take away all the other expenses to arrive at our net profit. Yes. So I think really the next stage is to work through an exercise and see how this works. See you in the next video.